And again, good morning and welcome to the weekly life insurance webinars featuring, again, carriers that you have contracts with or can become contracted with, learning the sweet spots of the products that are offered to you and allow you as agents to have additional confidence as you go out and speak to your clients about fulfilling their needs. This is Mark Conter here at the Messer Financial Office. And just a couple of housekeeping items before we get started today. Please place your phones on mute. Even though we do have the phones muted, sometimes something will slip through. You'll notice on the screen there's a place for you to type in your questions. So please go ahead and type in any questions during the presentation, and we'll come back and address those at the end. And again, please stay with us until the very end. We'll review the high points of the product and also bring to your attention a bonus that will be made available to you. At this time, it's my pleasure once again to welcome Christy Majorian from the Assurity Group. She has presented for us before, and she is again scheduled to present again later on. Probably you're going to hear from our carriers about once every quarter, ladies and gentlemen. So you'll hear different products and different availabilities. But again, Christy has been not only to our offices here, but she's out in the field as well. So again, welcome her. And Christy, good morning. Thank you.
Good morning, Mark, and thanks everyone for joining us this morning. I hope that through these webinar sessions, you guys are able to get a lot of new fresh ideas on how you can go approach existing clients and also looking for new clients. So with that, this morning we're going to talk about a new product that we rolled out here at Assurity in October, a joint whole life first to die. But first, just for you that aren't as familiar with Assurity, I'd like to give just a quick brief overview. We did celebrate our 125th anniversary in August, so we have been around for a long time. And some of the things that we have learned through those years really is where we fit within the market and where we see the need within the market the most, and it is in that middle income arena. Now, most of us live in areas and are surrounded by people who are in that middle income market, which makes them our number one focus clients. And we know that, they are big on things being simple. They're big on convenience of, ease of being able to do business. And so those are things we really have gone back through and really focused on, all of our marketing activities, as well as when we look into new products of where we see that fitting. So briefly, for you that aren't familiar with the joint whole life plan, I just want to give you kind of what that definition is. Just to make sure you understand, there are two different types of joint whole life out there. So we have a joint whole life that is a first to die and a joint whole life that is a second to die. Assurity's product is a first to die, which means the two individuals that are on the policy, after the first one passes, that's when the benefits are paid. So I always like to just review that a little bit, because I know with the products that were around back in the 80s and early 90s that kind of fit in this market, it was set up a little bit different. And we'll get into some of the features of why now, even more now than ever, this first to die product is something you want to have in your portfolio. So the other question we get all the time from agents is, why did we decide this on a participating whole life chassis? A lot of companies that have had products in the past that have been a joint whole life, they've always been set up on a term chassis. And one thing that as we built this product here at Assurity, again, thinking about that middle income arena that we work in, is we want them to be able to have that permanent protection. Depending on the situation, and we'll talk about some of those different sales ideas and how that actually would benefit them more on that whole life chassis. We'll get into that, but it's just important to remember that the way Assurity does structure all their products is thinking of that middle income client in mind. So what I want to do first is just kind of talk about life insurance. We know traditionally life insurance it's the main use for life insurance always is it's a benefit after someone passes away. And for those of you who have worked in that life insurance market, we know that that's not always the case anymore. We see life insurance policies that are used to help fund college education. We see them used to help cover a mortgage. We see them covered with business situations. So there's many different things, but as we look at the products and again why this joint whole life fits now, I want to just kind of remind you of back of the 1950s a little bit. So this was an actual brochure that we had here at Assurity when our name was Woodman. This is one of the brochures that we had that agents as yourself would go out and use in the field. So we can see here, with you there, that home is protected. If this happens, your home is still protected. But suppose this happens. She will lose her home, and where could she find another place to live? What kind of home could she afford with the income she will have? If they can pay off the mortgage, she has a home if she wants to keep it, an asset if she wants to sell it, and an income if she wants to rent it. So a debt-free home is equal to a rent check every month for life. We see this. So this was a good way for how we used to market protecting a mortgage. Now, the one thing, from the slides we do see is times have changed, right? We see now more and more situations where we don't rely on just one income in that household. Traditionally, in most situations, we have two people that are working to protect assets that they have. And that's one thing when we look at this product, how we're helping them be able to do that, but we're not making them spend tons and tons of money to do it. So today we see that 19% of married couples with children, they do have a primary breadwinner. So those numbers have changed a little bit, but the big thing there, again, is to remember that fewer families rely on just one income. Most of them you're going to see are the dual income, and what they're really looking for in insurance-wise is something that is going to be a unique situation that will have a unique solution fitted to what their family needs. And so, other to think about, is that 65 market. We have over 10,000 Americans turning 65 every day. And I know you've probably heard this before. If you work in the senior market, you've heard it plenty of times. But I want you to keep that in mind as we go through some of this information this morning too, because I think you'll see some good ideas and good ways how this will fit. One thing to think about with the senior market and Social Security, we see that 52% of married couples receive 50% or more of their income from Social Security. Now, we all know those numbers are changing as time passes on too. But again, we're looking at two incomes falling on two Social Security incomes. So to support retirement, what happens if one spouse dies, if one partner passes away? We know that they do not get both benefits anymore. So before I get into some of the sales ideas, I want to hit on just some of the product basics so you see what kind of markets, again, that you could use this in. Issue ages in the product are 0 to 85. And what we do is we use a joint age. Now, this is one thing that is a little different. It's not as easy to calculate as pulling out a product guide. You do have to use our software to calculate that joint age. And you'll be surprised when you do that, where you'll see those ages range. We'll usually see, even if it's two of the same age, it usually knocks it down 1 year. So keep that in mind. Joint underwriting classes, we do have a few options. We still have preferred available. We have standard available. And we have a standard tobacco and a combination. Now, just to give you an idea of where these are falling with those last two, a standard tobacco rating would be if one person on the policy is a tobacco user and the other one isn't, they would fall under that combination class. If they're 2 tobacco users, it'd be that standard tobacco. So keep that in mind again when you're looking at, it's always easy to see where that one person will fall, but where 2 will. And this is something that when you put it in the software, it'll calculate that out for you too and let you know what underwriting class it is. Issue limits on the plan. We're going to start off for the younger clientele at $15,000. But once we're at over age 15, we'll actually go down to $10,000. This policy is set on that whole life chassis, as I mentioned in the beginning, and it actually mirrors our LifeScape fully underwritten whole life plan. So we will have that joint age 121. Premium structure is going to be guaranteed and level. And we're going to have a few different premium bands here. And also, we can see that policy fee is commissionable to you as well. One thing also to mention here, looking at those premium bands, again, going back on that middle income and thinking of one of the things that are important to them being that convenience, underwriting amounts under $149,999 is non-med, meaning not subject to a paramedic exam or lab work. So everything else will just mirror our regular whole life, that they'll have the same dividend options, commission schedule matches. Everything regarding loans that they will have access to do will all be the same as well. One thing we did do on this plan was include some of the different riders, and this is where you'll see some of that ability to really customize to what your client is looking for. So if you have a young family, we have that child's term rider that you can put on there. That waiver or premium term rider, when you're really looking for that perm-term blend, we're going to have that capability as well. Do a lot of quotes where we're doing like a 10% whole life and a term, especially with young couples. It works really well to get them started. We do have paid up additions rider available as well, and we do have the accelerated benefits built in on the plan. But what I want to go over next is probably some of the things that are circulating in your mind and things that you're going to have some questions on. And this is going to be, what happens if a couple gets a divorce? That is the #1 question we get on this product. And, the great thing is, again, when we built this product, we thought of all of that. So if a couple gets a divorce, they can decide to leave the policy as is. They don't have to do anything with it if they don't want to. If they do decide that, they don't want to have the policy together anymore, we will split it right down the middle. So if you had, just for instance, a $200,000 death benefit, and let's just say that there was $1,000 cash value, just for simplicity of numbers, each person would be eligible for $100,000 of death benefit, and they would each receive that $500 cash value. So we will split it right down the middle. The other question we get alongside that is, what if the surviving spouse still has a need for life insurance? What do we like to do there? What can we do there? And what we will do is, with the plan, we will go ahead and allow that spouse to purchase additional life insurance if it's done within 6 months. So within 6 months, that person can purchase a standalone whole life plan and not have to give any evidence of insurability. So something, again, that fits really well and gives those opportunities when we do face it unexpected. What if that couple dies simultaneously in a car crash? We thought about this as well because those questions come up. Your clients, even though they don't want to think about it, there's always those possibilities, and we like to make sure we can answer all of those before just throwing a product at you. And the way this works is, if they die in a car wreck right away, we will pay 2 death benefits. So if they had that $200,000 death benefit, we will pay $400,000 to beneficiaries. Now, let's say you have one situation where one person passes and the other one, let's say, is on life support. We will never make a family make a decision of pulling the plug in order to receive a death benefit. We have an option where we can roll, just like from that surviving spouse, roll it into a new policy. Even if that person is in the hospital, we still will be able to exercise that and have them on their own policy. So, if they are able to recover, again, they will just be like the previous situation and have that additional coverage. If they do happen to pass, let's say 3 weeks down the road, this policy would still cover them as well. So it's never going to be an either or. There's always going to be some options there. So now what I want to go into is some of the different markets. The first one to think about, and this is the really obvious one, is two people that rely on two incomes. Now, this could be for a multitude of situations, so don't leave it just in your mind as couples. Think about people in business situations. Think about, I see a lot of parents and children situations. So any type of markets like those are things that you can use this product for. The DINKs, which are the dual income, no kids, it's a huge market. And we'll get into some examples there. Replacing Social Security. And a secondary market that we have really started to pick up traction on is the business market with buy-sells. And one thing to think about with these buy-sells is, most time when these kind of arrangements are made up, with attorneys for the businesses, they are set to put insurance products in place, or have annuities, money in different accounts set in place as part of this agreement. And what we find is a lot of times within those agreements, everything will get honored except for the insurance part. So it's a good option here that we'll talk about as well for you to go back to businesses and see, did you have that insurance set up in your buy-sell? So what I want to talk about first is the DINKs, the dual income, no kids. Things that we see is, people are not having children as young as they used to. We have a lot of people now who are going through college and wanting to get into those careers before they even think about having a child. We have a lot of couples nowadays that are deciding not to have children, with the different capabilities within jobs, being able to work remote, being able to work, companies expanding over in other countries. There's a lot of couples who decide not to have any children. And the one thing for you to think about with this market is, that they have a lot more disposable income. So with this, we really are targeting the 99% who have the two incomes with the DINKs. Now the DIWKS, so the dual income with kids, depending on the situation, all of these, what we'll talk about here, can definitely apply. It just depends on their unique situation again. So if we look at DINKs, what kind of risks do they have? They have really created that lifestyle based on both incomes. Buying houses, having new cars, taking vacations, paying off student loans. What we really see there is all these different risks, and the first concern they do have is paying off that debt. They want to be different than others and, have that house paid off in 10, 15 years. They don't want to do that traditional 30-year mortgage. Student loans, while paying student loans, we go back and get master's degrees and doctorate degrees. So they're building up a lot of debt and, paying that as they go along, so they're not getting stuck with that interest. Now, again, looking at that two incomes, that monthly budget really does rely on both of those in order to make sure everything does get paid for. So really think about that with this market is, even if it's that couple that lives in that house in that average middle income market neighborhood, chances are a lot of those DINKs are going to be fitting in this situation. So what I want to do now is look at a case study about this plan and see, where we can go with it and what we will do with it. So looking at the couple here in our case study, we have two under 30 here. We have Cindy and Kevin. They are in good health. Both preferred status when it comes to underwriting. So, they're the perfect client that we are looking for to sell an insurance plan to. Also, though, the one thing about this market is sometimes they're a little more difficult to do business with because they will have a lot of questions. They want to know how these plans benefit them right now. And what I'm going to give you now is going to be how you're going to show them that. So we're going to take a look at that mortgage that they have, what they're paying. So this situation, we had $175,000 mortgage. They're paying a little over $1,000 a month mortgage on that house. Student loans. We do have student loans here, and as we all know, there's stuff in the news every day about student loans and how expensive those interest rates are. You can see here a 6% interest rate on a student loan. That's pretty crazy. Now this is probably here on 1 year of college, paying $244. But what about the loans that, if they're still in school, they may be taking out that have a higher interest? I know just from my own personal experience, I went back to school here a couple years ago, and I have 2 loans right now that have a 10% interest on them. So, you know, those numbers, while we all think they would be low, they are not. Car loans, again, that's something that these dinks want to have. As they start off their adult lives and their careers, they want to have the house. They want to have that new car. So we can see here we're looking at a car payment of $476. So just to kind of summarize up their debt and what they're paying each month, we can see that the debt that they have is $227,000, and right now what they're paying is $1,737 a month for that debt. Now, of course, you know, being the dinks, we know they do a lot of fun things. They take a lot of vacations, you know, try to put that money away. So we want to think about the $1,737 and how big of a chunk of money that really is. So right now, as is, with that income, between the two, $110,000 income, assuming that, you know, there's no big bonuses or any other income coming in, they're in that 25% income tax bracket. You see right there, they're taking home a little over $6,800 a month. So we're looking at right now 25% of their take-home pay is going towards paying off debt. You know, life is good. You know, as long as things are moving and income is coming in, things are going to stay that way. They're not going to have any issues. But if something happens, let's assume Cindy does pass. You know, what happens? We look at that $45,000 house income, things are down quite a bit. So now that $1,737 becomes 61% of the total income. You know, that makes things a little more difficult. So same scenario, if Kevin passes away, you know, the one thing to think about that, especially with the dinks, you know, they're trying to fund that retirement because they know from what they hear, it's not going to be around, you know, there's not going to be a lot around by the time you actually get to retire, and what's your retirement age? They put a lot of money there, and a lot of them think that if something were to happen to a spouse or partner, that they're going to have that money to live on. But we know it's not going to last as long as they think. So, you know, here with Kevin, same situation. Well, if he passes away, his $65,000 of income passes away as well. So again, here we see that $1,737 becomes 42% of that take-home pay. So again, you know, life is not good. So if we were to look at the cheapest option out there, which would be purchasing term insurance, we can see there that the total payments they're making, we're going to do $347 a year for him, $300 for her. We're going to see total over 30 years, they're going to have paid a little under $20,000. So one big advantage that is attractive is it is inexpensive. Whenever they can save money and have the protection, people always like that. Also, they're going to have that ability to convert. Now, one thing is we do send every year, if someone has a term plan, we will send out a letter on their, about 60 days before their anniversary, we'll send a letter out talking about that conversion. But depending on, you know, where they are, do they still live in the same location? Are they still working with that same agent? Is that agent still around? Kind of determines what happens there. The big disadvantage that we have is it is temporary coverage. So especially for this dink market, they don't like knowing that in 30 years they will have just thrown potentially $19,000 down the toilet. Looking at whole life now, the premium is going to be a little bit higher. That premium we're going to pay, $19,000 over the 30 years. We see here it's $93,000, but we also see that they have a cash value of $126,000. So just to think about there. So they are going to have a gain, as you can see, the cash value versus what they paid in. So this is something where those dinks, again, we're looking at funding retirement earlier and putting more in. Here's where we can see where that gain will be a highlight for them. So the advantages there, I don't have to read them to you. We can see, the biggest thing there is permanent coverage. It's never going to go away. They're building up cash value, have options to use that if they were to need. So, the big disadvantage there, upfront cost. It does cost a lot more than that term. But now if we were to compare two individual plans with whole life versus that first to die. So we can see down here that premium for Kevin would be $22.90 and for Cindy $22.17. So that's going to be a total premium of $4,507. Now if they do choose to do a first to die plan, that premium is going to save them about 31%. And I will, I know this will be on your guys' website afterwards, but I will send these slides over too if you want to have these for examples. So next I want to talk about Social Security. We see how well this is now of playing that role with those that are retiring. It is a permanent problem. It's not going to be solved easy. It's not going to be solved quickly. It's not going to be there. So one thing we still got to look with our older clients is, what kind of things are we going to do and what we're going to be able to do to help them out to give them that solution. I know right now we have a couple of employees here in our office, one in our sales area, bless his heart. He's 74 years old and he's still working full time. Of course, part of it is he's not ready to retire and live that relaxed, easy life. But he knows just what things that went on in his life, he needs to put a little more money away to maintain that same lifestyle. So the case study we're going to look at here is going to be John and Linda. So you can see here we're both average health. So what we're really looking at here is going to be that average middle income couple. Again, staying in that market. Here we're in our beginning of our senior market, looking at where we are with what we have put away for retirement. How long is that going to last us? How much are we spending each year now? One question I have an agent who works exclusively in this market, so kind of your pre-retirees. The biggest thing he does is he asks them for 1 month to keep track of all of their expenses. Now, this is not just the bills. This is the other stuff. So, the going out for lunch or dinner, the playing golf, whatever it may be. And he looks at that and really uses that number to times out, what you really are spending besides your main living expenses that you have. And, I think that's a really good way to look at with making them to realize, do we really have enough money here? So with this example, what we're going to talk about is if something were to happen to one person, what are we going to be able to do to keep that other one steady through those retirement years? So what we're going to see here then is with those, they're planning to retire the same year. So John will be 67, Linda will be 65, and the projected benefits that we're showing for them is going to be $29,945 for him and $18,815 for her. So one thing for those that aren't familiar with the way this works, what happens if John passes away? we know that both of those benefits are not going to be kept. The way it's going to work is Linda will continue on with that $29,945, and that $18,000 will disappear. So even if that's what they had intended to live on, roughly here, $48,000 annually, she's going to be living on under 30. This is a graph just for you that like to look at that. What we can see here based on those, that situation, if John does pass away, what we're going to see here though is Linda is going to be short about $94,000 over a 5-year time period. And that's assuming just, a 6% return on the death benefit that John may have that would be needed to replace. So in order to eliminate that, we're going to need about $87,000. Again, just want to kind of compare the cost there. We can see for this couple, buying them at ages 55 and 53, we're going to save them about 34%. So I know we have a lot of clients and even some agents will be thinking, well, as long as they're funding things properly and doing this and doing that, a couple of things I want you to think about there. So let's say, I have the best financial advisor in the world. I have someone who has helped me, beyond my 401k that I'm paying into at my job, of how to put away money, how to pay off debt. One thing I think you can kind of get to ask the question to make sure that what they think they have is what they have. I always like to ask them then about disability insurance. So, who do they get you their disability insurance through? A lot of times they won't have an answer for you. And I kind of take that as my way to be able to move in with a conversation of other pieces of that puzzle of theirs that may be missing as well. So next I want to talk just a little bit about that business buy-sell. For those that do choose to enter in a business of their own, you as an agent, I think about the local coffee shop down the street that I stop at all the time. They had to invest some money and some time in the beginning, to be able to build that business into a success. And, one of the things that we're very fortunate that most of them will do is they will meet with an attorney and make sure that they have that plan in place. But the thing is that attorney won't help them or doesn't have that responsibility of helping them make sure that the parts that don't involve them that they take care of. And so when we think about this market here, I really want you to think about that. How, if the situation happens, how many of them actually reach out to an insurance agent to buy that life insurance? How many of them have those buy-sell arrangements that actually have all the pieces in place? And what I found this is just from agents I've spoken to at different meetings. Had them go out and ask 5 of your business clients, who their buy-sell insurance is through. And I think you'll be very surprised to see that maybe 1 out of those 5 actually will have it. So there's different events to consider when you think about, a business relationship of things that could happen that could throw off that business. So we have those that are thinking about, hey, we've been doing this for many, many years. I'm ready to retire. Someone who is going through a divorce, that could cost a lot of money and take away time from that business. Someone who becomes disabled, depending on the business, that really could affect things. And again, someone who passes away. So how does this plan work, and what do most business owners think will just happen? One owner dies, the surviving owner purchases the deceased share of the business. Now, I want you to think about, where do they get that money from? If they don't have a plan, if they don't have an insurance plan in place for that, where do they get the money from? Are they going to dig into their working capital, which could end up hurting the business in the long run? Do they borrow funds? Throw someone else into that business relationship? Think about if they were to get loans or anything, that extra interest, how much more that's costing that surviving partner. And just some questions to think about. And I'm kind of hitting more of these questions with the businesses because I think it's one where you have more opportunity to dig in, and this is where you're going to find those bigger policies. I have an agent that's strictly what they do, and it's all about asking those questions and really making sure that they, where do they see things and where do they want that business to be in 5 years, 10 years, regardless of the situation, if they are there or the partner is there. So just some questions to think about. One that I think is a really, really important one is, do you think the value of the business will increase in the future? Now, anyone who is in a business that wants it to be successful, they want to have that value to increase, right? And even for those that may have some type of a buy-sell plan in place, for example, maybe they both own term policies on each other. I always like to follow up with this question of, would it be beneficial to have that life insurance policy already in place where that death benefit can increase as well? Now, for the businesses, there's tons of different features that this joint whole life policy can bring to them, but another one I always like to think about is a situation where, let's say, they buy the policy from you today. They do a little overfunding in it just to have those funds if needed. Well, let's assume that maybe business is bad for a couple years. If we have things going on in the economy that kind of induce that a little bit, that a lot of times banks aren't going to be as willing to loan money. How nice is it for that business if they need to get some money, if they can borrow from the cash value of their whole life plan? So just something to think about. Having flexibility in those premiums, that's great as well. Guaranteed premiums, so if we buy the policy when we're 30, at age 60, we're still paying the same thing. Budgeting should be a huge part of any kind of business arrangement. And again, building that equity to utilize for loans in the future. What better way to do it than not have to pay that interest back to a bank? So case study here I want to talk about is these two lovely ladies who own a successful interior design business. They've met through and figured out $300,000 would be the value today to buy that other half of the business. They like the idea, of using that whole life, but paying for those two whole life plans, as anyone would, they see it as that's very, very expensive. So again, what we want to show them is looking at that monthly premium savings for that joint whole life versus two separate policies. So here we can see they're saving almost $300 a month by purchasing a joint whole life. And again, even in a business situation, they have all the same features. So if that business does dissolve, they still would have the option to split the policy and split that cash value. If one happens to pass away, the other one can still purchase another policy. So that all of those features stay regardless of whatever market you may be selling this product in. And think about, let's say that business can go ahead and budget that extra $300. What could they do with that? Putting in more money, paid up additions, and really fatten up the cash value of that policy. Purchasing other layers of protection. If you traditionally sell life insurance, it's an opportunity there to look at, well, how could, they want to look at covering their families too with some of that money. Do we want to look at larger death benefits for them, just for themselves, for their families? Do we want to look at the disability insurance or critical illness? Or what they could do by just investing that savings back into their business. So again, there's many ways here that you can, depending on the business, depending on those clients, of how you could show them how they would benefit from saving that money as well. So again, just to kind of review with you, for those dinks, to give you an example, I have an agent, and for those of you who think maybe this really isn't the market for me, I don't really have a clientele that I think would be fitting with this market. Well, I tell you, we have an agent here who I thought he was the one furthest from my mind that would have interest in this product. Now, I helped him run a couple of quotes on a couple of young couples, and just thought, well, he's testing the waters, just wants to see some numbers. Well, he right now is the #1 salesperson of this product for the company. He sells to young couples everywhere, and what he does is he does that perm term split. So he'll utilize that term rider for those clients and really make them see where that savings is now and how they can use that in future to purchase additional life insurance. Now, again, benefit there with the dinks or even the dual income with kids. The budget's always a little bit tighter, so when you can show them a savings, they're going to like you for it. The senior markets, just to remember there that we think things are okay, but if something does happen to one spouse, part of that Social Security income is going to disappear. So what do they have to replace that? And business owners, I just like to ask them, what do you have in place for your business to survive if you have, a tragedy happen? Just things that they think about, but like we've all seen working in this business, people think, the things like that necessarily won't happen to them. So I think it's really important to have some questions that you can use with those clients to make them see of why adding in an insurance plan like this will be beneficial for them while also saving them some money and giving them some future opportunities for cash values and growth. So with that, starting that conversation, what I would ask of you would be here in the next week to think of 2 clients you have in each one of those markets that you could make a phone call to. Whether it is to do a review and see where that opportunity may be, whether it is with that business asking a few more harsh questions and finding out what they do have in place. Sometimes that might be a little bit harder market to crack, but the nice thing there is once you can get in and you help one out, they are more than happy to recommend you to other people. Business relationships, they have all those little different societies and things that they are a part of that they will be more than happy to share your business card with. So with that, just last thing, just advertising, we have our Leaders Conference trip qualification for Dublin, Ireland. Any policies that you sell right now that are disability or critical illness, those ones do count double for the entire year. So just as an example, if you were to sell $40,000 of disability insurance, it would count as $80,000 of credit, and you would be fully qualified for convention. Also, just looking at those joint whole lives, again, if you can get a few of those business ones, they are some big bucks. So really think about that. And